That's perfect. All right, you look great. Are you ready?
I would have done my hair if I'd known I was going to be on TV.
Well, you look good. All right.
Yeah, go for it.
Hi, I'm Tobias Carlisle, and this is the Acquirers Podcast. My guest today is Jake Taylor. He's written a fantastic new book, and he's got a call from Charlie Munger. We're going to talk to him in just a few moments.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Jake has written the hottest book on global Wall Street right now. It's called The Rebel Allocator. It's about a fictionalized Jake Taylor meeting a fictionalized Warren Buffett. And Charlie Munger loved it so much that he called Jake up to talk about it. And Jake, establishing dominance, something like that, refused to take the call or screened the call. So tell us what happened. Charlie Munger called up. You didn't want to take his call. You called him back.
Well, I only took this call because it was the same 310 area code, and I thought it might have been Charlie. So no, I'm just teasing. No, I just I don't answer the phone at the office, and my assistant answered it, and she happened to be working from home that day, and she called me and said, "You're never going to believe it, but Charlie Munger called, and he wants you to call him back." And I was like, "All right, don't mess with me. All right, I'm not in the mood for that kind of thing." No, here's his number. So then I'm like, okay. And I kind of sat there for a second, like, what am I going to say? I don't even know. What do you tell God when he calls, right? And so I dialed the number, and a woman answers, and I believe it's his like daughter or daughter-in-law or something like that. And she's like, Munger residence. And I'm like, is Charlie there? He called and wanted me to call him back. Like, I'm dumbfounded. I don't even know what to say. And she says, hold on a second. And then like 2 seconds later, Charlie's on, and he's talking about my book with me. And I'm just sitting there wondering, is this real life or not?
So I've heard him say at different DJ co-meetings and other things like that people send him so many books. And so do you know why he plucked that out of the pile, why he read it? Like, he's read it cover to cover and loved it. I
mean, that is what he said. He said, I started reading it, and before I knew it, I'd read the whole damn thing. And I was like, wow, that's amazing. And I don't know why this particular book grabbed him. I mean, it must have been, I sent it was around the holidays. So maybe I like caught him at a soft, weak moment or something. And he wanted to read something that was a little bit different, but I don't know. I couldn't tell you. I don't have a good hypothesis of why he would ever read my little book that I sent him.
So what did you talk about? Can you divulge?
Well, I mean, he was adamant that I figure out how to get it made into a movie. And I was like, wow, I never really thought about that before. I had been researching when I was during the writing process. I wanted to tell a good story. I knew that much, and that led me to doing research actually on like screenplay writing and like, how do you craft together a story with like characters that arc and, high points and low points and emotion. Like, how do you bring that into a story? And but I never really considered making a movie out of it. It was just more like, let me just steal some stuff from Hollywood that I can use to kind of craft my own little story. And he basically was like, you should figure out how to get this made into a movie. And I was like, oh, okay. And they even had some specific like character ideas and
some
like
criticisms.
Oh yeah, for sure. Like, everybody's a critic, right? So but I was like, oh, yes, sir. I just didn't want to say anything stupid and make him hang up on me. So I just was writing everything down that he was saying. And, oh, good point, Charlie. Yep. What do you think about this? I tried to ask him good questions.
So speaking of that, so Wall Street Journal, Jason Zweig, who writes the Intelligent Investor column, and he's written the introduction to the intelligent investor
Mm-hmm.
and sort of legendary Wall Street Journal columnist who's at a lot of the value investing events around the place. He picked up on the story and he got in contact too.
That's right. He gave me a call. Well, actually, I had him on 5 Good Questions when his book came out, and so we kind of stayed in touch. And he, I knew that he would appreciate this Charlie story, and so I wasn't like telling this story publicly at this point because I just wasn't. I don't know. Something felt a little bit weird about it to me, like almost like if the pretty girl at school gave her your phone number or gave you her phone number, and then you don't go around telling everybody about that because maybe she's like, why is he talking about that? So I was telling just friends and people who I knew would appreciate the story, and then a couple like weeks later, Jason called me and said, hey, I think there's enough here for me to do a story on it. And I didn't even know what he was talking about at first. Like, what do you mean? Like, it's like, your Charlie story. Oh, okay. Yeah. I mean, how can I help? I'll ask. And he asked me a bunch of questions and background, and he'd apparently called Charlie to kind of verify everything and make sure I wasn't full of baloney, which could have been true. But yeah, so he did a write up on it, talked about the book a little bit, and mostly it was about Charlie and how amazing it is that this guy who's 95 years old still has time to like reach out and make somebody's day. And it's pretty special. And he was completely right. It's
a cool book. It's an unusual kind of approach to, it's a dry subject, capital allocation, and you stuck it right there in the title, which is impressive because you're going to scare a lot of people away with that Rebel Allocator. Rebel's great, Allocator, scary. So the way that you've sort of taken what's a pretty complicated, dry subject and made it a little bit more interesting is to write it in this narrative style where you've got characters and they interact. Do you want to tell us a little bit about the story, and then we'll dive into the lessons from the capital allocation?
Yeah, I mean, when I started writing this book, and this firsthand because you've been a really good friend on this project, especially in helping me to figure out what the hell I'm doing. And I've probably sent you like 10 different book proposals of things that didn't end up being this book, and it's been all over the place. And that's like
very good.
At one point you were probably like, what the hell's this guy even doing? Like, he's all over the place.
I'm glad you got it all the way to the end. It's a huge effort to get it done.
Yeah, for sure. So anyway, the long story short is the book originally started out as a typical nonfiction. I noticed that I would see a lot of, being an investor, I would see a lot of capital allocation decisions. And that was a lot of what I spend my time doing, is assessing management. Like, how are they doing? Like, if I was put in their position, would I have made the same moves? And when I say capital allocation, I don't just mean like dividends or buybacks, because that's kind of how it gets lumped a little bit. I mean everything from paper clips on up to buybacks. Like, it really is, what does this business spend its money on? So anyway, I started out working on trying to solve this problem of seeing a lot of bad decisions made by people who I knew were otherwise very intelligent. And I figured, when I went to business school, I didn't really get sort of a holistic explanation for a practitioner of how do we do capital allocation. You get little bits and pieces of it all over the place, but no one really put it all together into a big pile for it and made it so that you could process the whole thing and then make better decisions. So anyway, I had this nonfiction book in my mind, and I had a book proposal, had a couple book offers, but something about it just didn't feel right. Like you said, I mean, it's boring, potentially very boring subject. And also around that time, I felt like I was just getting a lot of little nudges from the universe that you have to tell a story if you want it to have any chance of a lasting impact. And I actually lost a close friend who was my age around that same time. And it made me reevaluate, like, really for me, it was sort of a mortality gut check of, if this book came out and I was to die 6 months from now, like the nonfiction book, no one would care. Like, it would have been over and done with. But if I could tell a story, there's a chance that it would be much more interesting and actually last and be a better example of good work for I have 2 sons who are, 10 and 7 years old. And I thought, I can't that can't be my legacy, is like this dry, boring book that they would never want to read. No one would want to read it unless someone forced them to read it. So anyway, all these things push me towards telling a story. And that's when I basically threw everything I had been working on in the dumpster and started over from scratch, trying to tell this story. And it's basically a coming of age story of this college grad who, through a little bit of luck, meets a Warren Buffett, Charlie Munger type character, who teaches him through a bunch of interactions good capital allocation, all the way down from basically like microeconomics up through, if you were running a Fortune 100 company. So that was what I tried to accomplish. And all along, hopefully applying a little bit of a veneer of appreciating how capitalism makes our lives better, and how capital allocators are the kind of the grease in the capitalist system that make all of our wants and needs get met by capitalism. So, it's kind of a crazy, and like, it sounds like very chaotic to try to do all these things with one book, but I don't know. That's just kind of where I ended up, and I just kept pushing through. So
well, it works really well, and that's probably why Charlie reached out. I think one of the problems with capital allocation is that I think value investors are really the only ones who think about it, because anybody else who's come from business school, who's learned efficient markets, that's not really it's not something that's ever considered. It's not sensible to that framework. It's only value investors who think about this thing's making some excess returns. What are they going to do with those excess returns? Is it going to grow the business? Should we even grow the business at all? So you sort of deal with some of those questions in the book. Do you see anybody out there today who you think's doing a very good job with capital allocation, and why do you think they're doing such a good job?
Oh no, there's scores of good CEOs, and really, actually, I think the CEOs probably get too much credit. Based on my experience of serving on a board for a private energy consulting company, and getting a little bit more behind the scenes look at some corporations through interactions, I think that the CEOs, it's sort of like being the president of the U.S. Like, you get the blame for all the economy, anything that's happening, and you don't deserve all of it. Like, you inherit a lot of things. There's a lot of inertia to everything that you have to kind of work through. So I think the CEOs get too much credit when it's good, and they get too much blame when it's bad. But having said all that, yeah, there's so many great capital allocators out there. Obviously Buffett and Munger are the gold standard at Berkshire. But you have so many really smart people who are doing this right now. It's almost not even like worth mentioning them by name. There's so many, but what is very interesting about them, and I think is really well highlighted in William Thorndike's book, The Outsiders, is that all of these people are willing to think for themselves, and go against the crowd potentially. And that's where one of my goals of my book was to potentially inspire people who read it to have the confidence to make the decision for themselves. I would love if someone read this book and decided, you know what, I can figure this out. And none of it is like rocket science, right? I mean, there's no higher math required. It's all just being willing to sort of stand on your own intellectual 2 feet and figure out if like what I'm doing makes sense logically. And it's very difficult for some people to do that, because it does take an emotional toll, for sure. I mean, anybody who's done investing, really in anything, especially if they've gone a little bit contrarian, knows how painful that can be, right?
Absolutely. There's a lot of discussion about buybacks in the media at the moment, and it's funny. Yeah. It breaks along two lines, and I think that they're both kind of odd lines. One of them is this idea that buybacks and dividends are somehow hurting workers in the business. Mm-hmm. So that's a political one that I probably don't want to touch. But the other one is that all buybacks are bad from an investment standpoint, because and I have some sympathy for this view, just because in the aggregate, the bulk of buybacks seem to happen at the very peak of the market. And then when the market draws down and the equity gets a lot cheaper and you think this would be a really good time to do a lot of buybacks, that's when the buybacks sort of tend to dry up.
Yeah, that's right. I think that's if we look at the sort of the base rate of buybacks, they are done in inopportune times, and they're done in a herd like mentality. And part of that is a little bit understandable given that, theoretically a bull market, everyone's feeling good about the economy. Everyone is kind of drawing straight lines up and to the right for their business, for their stock price, right? So when that looks like all systems go, like, okay, maybe I should buy back right now because it's cheap compared to what it's going to be in 5 years, because look how it's gone up for the last 5 years, right? Well, reversion to the mean is a very difficult thing to avoid, although we seem to be doing a hell of a job right now. But I think, it's kind of hard to blame them a little bit in some instances. In my book, I tried to give a couple of outs for that for a CEO making that decision on buybacks. First of all, one of the things that I kind of borrowed from Ben Graham actually was thinking more about your partners or your shareholders as business partners, and not so much as this group that you kind of have to try to keep happy and like throw a little dividend at them to keep them at, the natives from getting restless. So one of the things that I recommended through the character was that at a minimum, a company should be willing to do buybacks at 1x price to book if it ever gets down there. And the point being for that is that if you have a partner or a shareholder who needs liquidity, I think you're doing them a good service by providing them at least accounting value for the company. Granted, like if everybody showed up and wanted to sell at one time, maybe we couldn't meet, price to book F1 at that point. Like maybe it would be drowned and like we wouldn't have the cash to do it. But if someone, you don't know their financial situation, and if you treat them like a partner and you want to take care of them, you should at least give them like book value for their company, right? I think that's a very noble thing that capitalism can do. Now, let's say that you're a CEO and you don't know what your company is worth, which first of all, a little bit of like shame on you, because if anybody knows what a company is worth, it should be the CEO. However, let's say you don't know. One option is to just dollar cost average, basically buy back no matter what. Sometimes you're going to be wrong when the price is too high, and you're going to hurt your remaining shareholders by buying back at too expensive price, but you're going to benefit your departing shareholders. Other times the price may be low and you'll benefit the remaining shareholders and hurt the outgoing shareholders. But I don't think that I think the CEO should think about both remaining, incoming, outgoing shareholders as business partners as much as possible, and try to treat everyone fairly, and a little bit more of a holistic kind of stakeholder view of it, and not so much how do I take advantage when my stock price is ultra low and just plow into buybacks. I understand as an investor who's going to be holding on to that through the buyback, like I love that, but at the same time that you are taking advantage of one of the partners in that situation, and I think that shouldn't be lost.
So you're an investor. You're a value investor, and you run a firm in Sacramento and Folsom.
Mm-hmm.
Firm's called Farnam Street Investments. What's the derivation of the name? Where does that come from?
Well, I was sitting in 2009 in Omaha, trying to launch a fund and come up with a name for it, and I didn't want it to be like Taylor Capital Management or I don't know. That just seemed kind of grandiose to me. So I'm sitting there and I see Farnam Street as the address, like one of the street signs. And I knew that both Berkshire Hathaway's headquarters and Warren Buffett's house are on Farnam Street. Like they're on the same street. And they're like, I don't know, like 3 miles apart or something. So it just clicked for me. Like, what about Farnam Street as a name? And that's how it happened. And then, of course, the Farnam Street blog came along a little bit after that, and credit to Shane, like he's he's done a hell of a lot more with the name than I have.
It's good marketing for you too.
Well, we do get pretty regular calls like, hey, is Shane there? Oh, you're looking for the Farnam Street blog. This is
Farnam Street.
This is the wrong Farnam Street. I'm sorry. I know it's disappointing for you, but Shane doesn't work here.
So what's your investment strategy there? It's value investing, but I always say value investing is a very broad church. You've got the franchise guys at one end and the very deep value, special situations, lots of different ways that philosophy can be expressed. So what do you guys do?
Well, basically, I'm looking for things that I can understand that seems like I'm getting a good deal. And I don't like to pigeonhole myself into one specific kind of box or flavor of value. So sometimes I'm buying cheap assets, on a low price to book. Sometimes I'm buying cheap cash flow or earnings or, an EV to EBIT type of thing. And it's all stuff that's cheap now, right? And I'm looking for reversion to the mean there. Sometimes I can see something that makes sense to me in 2 to 3 years. I can kind of get an idea of what it might be worth, and it seems cheap. And I have a pretty good idea that it might work out okay. And then that's a potential investment. And sometimes it's like actually just finding really good capital allocators and trusting that they're going to make the right decision over the next 15 or 20 years, and basically sort of outsourcing the investment to them, and letting them manage the capital through the conduit of a business instead of in my fund, for instance. Go ahead.
Therefore, your return over time looks more like their internal return rather than sort of what the price you pay becomes less relevant as you get out to those sort of time frames.
Yeah. Although I'm still a value guy and I have a hell of a hard time pulling the trigger on some of these. I know that I'm dumb for not just buying it and getting my 15% compounding that I know intrinsic value is going to be over 20 years. But I still have a really difficult time paying up sometimes for that cap allocation skill, even though I know it's like one of the things that moves the needle the most over a long period of time. And I absolutely love it as a strategy for the anti-fragility of it. When rough times come along, these men and women are making moves to make their businesses more valuable. And like they're taking advantage of opportunities then. And they get up every day working hard and hungry to make my investment worth more. So it is tough for me sometimes to pull the trigger on, and I'm more like, all right, I'm going to wait, and I can't wait for this to get cheap for some stupid reason. And then I'm going to load up on it, or I'm going to nibble. And as it gets a little cheaper, I'll keep buying a little bit more. But it's funny as I talk to, I've been going to the Berkshire Hathaway meetings now 11 or 12 years in a row. And I've kind of fallen in with this crowd of guys who are like the OGs of the Berkshire meeting. One guy was at the very first one, and it was at some like little diner, and it was like him and 7 other people sitting there with Buffett. And I've picked his brain over the years a lot, and I asked him, like, God, what was it like holding Berkshire from like 1967 or something when he bought? And he says, you know what? Everybody who's that early has the same story. We all didn't buy enough, and we all sold too soon. And he's like talking about how his daughter's graduation or college tuition was the most expensive thing that he's ever, it was like a $12 million education in the opportunity cost lost of having to sell his Berkshire in like 1985 or whatever to pay for his daughter's college. So
have you ever asked, like, did they know at the time? Could they tell that Buffett was extraordinary at the time?
Yeah, they knew that he was special at that point. It was pretty obvious. But yeah, nobody bought enough and everybody sold too soon.
So in your firm, when you invest, are you investing domestically? Are you investing internationally? You go anywhere?
Yeah, we go anywhere. We have 2 products, if you will. One is the fund, which is a copy of the Buffett partnership with the same pay for performance setup that he has, or he had in the 50s and 60s. The other thing that we have is and the fund is really like a best ideas. It's pretty highly concentrated, and
what's concentrated? What's your definition of concentrated?
There's probably the highest position in there right now is about 25%
at inception, or is that you've run a little bit?
That's been added to, and it keeps adding as it goes down. So the actual capital deployed is probably even higher than that.
Right.
But yeah, so that one is a little bit obviously more aggressive. Our other product, if you will, is doing separately managed accounts, and those are a lot more retirement accounts, and those are also a lot more of people's kind of entire net worth. And that is we manage a little bit more conservatively. And what ends up happening is the fund gets individual stock picks for the most part, whereas the SMAs get more kind of an ETF version of that, a little more diversification. So for instance, 2011, Fukushima happens and Japan goes on crazy sale, just ridiculous. It's like hard to imagine how cheap it was. So in the fund, we're buying individual Japanese securities for 25 cents on the dollar, stuff that's profitable, pays dividends, but you're getting like crazy price to book value. Bought a bunch of those, and now I think our dividend yield on that little basket, because we've just held on to them the whole time, is like, I don't know, it's like 50 or 60% of our purchase price, right? Because it's just the businesses have improved and they're paying more dividends now, and our price was so stupid low. You just hold on to it and just keep cashing checks. So we do. So in the fund, it's individual securities like that. In the SMAs, that same idea got expressed through a Japanese small cap ETF. Not quite as cheap when you look through at all the companies within it, but still pretty damn cheap. So it's a little bit sort of like rifle versus a shotgun
Right.
approach between those two, and a little bit of diversification helps. It tamps down a little bit of the volatility, which is probably a good thing for the average investor to just keep them engaged and not like freaking out, which can happen if some of the swings in the fund they're wild. So it's good and bad, right? It's the lumpy 15% versus the smoother 12
Right.
sort of argument.
The famous Buffett line.
Yeah.
You prefer the lumpy 15 to the smooth 12.
I would too, but I don't know if investors do, honestly. I think the lumpy 15 may actually throw them off to the point where they don't benefit from your service.
Right.
And so I feel like sometimes giving them a smoother, lower number potentially, and I don't do anything special. We're still like crazy volatile compared to the average probably manager, just because of the stuff that we buy. But I do think that as far as a user experience goes for your investor, maybe absolute killing it returns that are super volatile you're not going to bring them with you on the ride, right? They're going to get off the roller coaster before it's over and they get to the finish line. And you've not really done anyone any favors at that point.
So how did you discover value investing? How did you sort of learn and evolve, and what was that path like?
Well, a lot of people don't know, but I started out actually. I ran the power grid for the state of California for a long time, basically like an electrical engineer. And I wasn't sure what I wanted to do when I grew up, and this is a job that I got right out of college, and I decided to go back and get my MBA, just to keep my options open if I wanted to go into management at the energy company. And my first year there at UC Davis, their MBA program, I won this lottery to go back and have lunch with Warren Buffett. I go back, and obviously he's amazing and like knocks my socks off. And I come back and I'm trying to learn everything I can about him at that point, often to the little bit of the detriment of my other school reading, because something had to give at that point. And it ended up being like my boring corporate finance books and stuff. But anyway, reading about Buffett, for me, it made perfect sense. It was like the inoculation thing that he's talked about, where, of course, like, why would you do this any other way? And I realized that I'd been a value investor my whole life. Actually, I was always looking on Craigslist for deals of like trying to buy something and maybe sell it for more later. Arbitraging stuff. I had probably my favorite. I was always a bargain shopper. I hated paying retail for anything. Probably my best story of that is that. It was like 2006 or 7, I think. And my wife wanted a Prius, and they were like pretty expensive at that time, relatively to other cars. And like you just couldn't find them hardly for a deal. And I was like, oh man, what am I going to do about this? I hate paying. I'm not going to go down and buy a new one. Well, so I'm cruising around on Craigslist and I find a Prius for about half the price of what the other ones are going, but it has a salvage title, which means it's been in an accident. And it's a very strong parallel actually to kind of value investing, in that a lot of these companies that you find, like, they've had an accident, but are they still drivable, right? So I bought that car after getting it checked out, which is like doing your due diligence on the company, bring it into a mechanic, and they give it an all clear. And I think I paid like $12,000 for it, and like those exact like specs for a car that was selling for probably $25,000 at that time. I'm happy to say that we still have that car in the family. It's still driving, and it's been 12 years of driving this thing now, and my amortization on this, as far as like, miles driven or even years driven for the cost, like, I don't know, I'm down to like $600 a year or something for this car. And that's just kind of how I've always tried to live my life, looking for bargains. So, if I'm willing to go on Craigslist and find a car that's salvage title, why would I not want a business that was also on sale for the same reason, and maybe the same potential outcome? So that's it. Like I said, it just clicked for me right away.
It's funny. I agree. I've had the same experience, and it's in many different things. And one of them is the buybacks.
Yeah.
Because Buffett says, work out the intrinsic value of the company, do a buyback at a discount to the intrinsic value. Don't do it at a premium to the intrinsic value. And that just makes so much sense to me. You're concentrating the intrinsic value, increasing it in the existing shares when you do it at a discount, and diluting it in the remaining shareholders when you do it at a premium. And so I just have trouble thinking about it in any other way. But that's not a lot of people think about it in those terms. I'm sure most of the people who watch this who are value investors say, well, of course, how else would you think about it? But that's not the common approach to it. And I think you see those two expressions of it, those two arguments in the media right now about that.
Well, what's funny is I think that, a lot of the CEOs that I've come across who are good capital allocators, they've actually just found it on their own through kind of logical trial and error, empirical study, more so than they wouldn't even describe themselves as value investors. Like, that doesn't even mean anything to them. They just know, well, when my stock is cheap, and I know it's cheap right now because I understand this business, I do buybacks. And when it's not, I don't do them. Or maybe even think about acquiring at that point because I have a pretty sound or strong currency, if you will. So all this stuff is so intuitive to somebody who's logical that it's to just even call it value investing is almost like this. Like I think Charlie said before, that it's almost redundant to say value investing, because if you're not getting a value, then why the hell would you be doing it to begin with, right? So
right. Well, I think I think it's just if you're in the value world a lot, you forget that a lot of people are approaching it in a different way, which is just, I'm going to buy it because I think it's going to go up. Yeah. It's gone up a lot. It's going to go up a lot more. I like FANG because they've gone up a lot.
Yeah, no, that's, what's funny about that is I've reflected a little bit. So we started our fund in 2010, and a couple years before that, I interned at another smaller value shop that my business partner now had started by himself. And when I think about when I found Buffett and when I got into all this stuff, value had just a crazy run from say 2000 to 2008, just absolutely killed it. And in a lot of ways, I should have probably been expecting reversion to the mean in value as a strategy, because it can't work all the time, right? Otherwise, then everyone would do it and it would stop working. But I was like a value Momo guy who found this and saw all this confirmation bias of how great this is. Duh, why can't I do this? Like anybody can do this, right? It works. Well, then it just completely stops working, right? And it took me 10 years post getting into it to realize how ignorant I was going into it. Just what a dummy.
Well, it's very hard, isn't it? You're captive a little bit to the time that you start thinking about these things. If you looked at it in 2000, you might not have gone into it, because even Buffett was getting the magazine covers saying he's lost it.
Uh-huh.
And then for a period of early 2000s through to 2008, 9, just being long undervalued stocks, in not long short at all, just long undervalued stocks, you sort of outperformed the market, but you went up where the market was falling from 2000 to 2002, which is unusual.
That's where that's where reputations are made, right? I mean, when you're up when the world is down, it doesn't get any better than that, right?
And 2010 is a very tough time to launch, because it's basically that's about the start date of value not really doing much. And with 2019, 9 years later, it's funny. I get a lot of questions like, do you think does this stuff work?
Yeah. No, and it is. I mean, it's a fair question. I mean, obviously, I'm way too much of a true believer to think it's going to stop working. Maybe even to my own detriment, for sure.
I'm right there with you.
Yeah, I know you are. I know we confirm our biases together.
Right.
But yeah, I mean, I feel fortunate that, when I see some of the other value managers who I really respect and I know are smart people, and to see the clobbering that they've had over the last couple of years, especially, not just like underperformance in a ripping market, but like going down hard when everyone else is going up, and huge, AUM outflows. I think to myself, like, by the grace of God, there go I. And I feel lucky that, we've kept it pretty conservative with a lot of cash over the last too many years for a raging bull market. But at least that's like dampened any of the really heavy like downward swings and things for us. And so we've lost ground on a relative basis as far as, the market leaving us behind. Actually, more accurately, like catching up with us. Like we were doing better than the market for quite a while, and then it caught up with us and passed us in the last couple of years. But yeah, if I had been fully long to the gills this whole time, we would have been really hurting, and who knows what. So I just feel lucky that we've kind of had the foot off the pedal during this time where things feel treacherous for a value investor.
It's very hard. There are lots of big names. Einhorn has had a series of disastrous years, and then last year I think he had a 25% down quarter. Q3 might have been 25% down. Ackman's in the same boat, and these are guys who are billionaires who started investing in the early 2000s or late 1990s, which is, in retrospect, a pretty good time to launch, but probably didn't feel like a good time for value at the time.
Yeah.
So there's a lot of big names who've been really hurt. You see a lot of big shops shutting down. It feels like a good time to launch, but
I know
it's felt that way for about 5 years.
Yeah, exactly. We've been trying to basically turn money away as much as we can. With like the fund has been closed for a couple of years. I have not been too eager to take anyone's money because I don't feel like I have any good ideas right now for the most part. I've got a few things that I think are interesting, but not enough to fill up a whole portfolio and feel like we're like really doing a good service for someone. In fact, even like we stopped charging on what we call excess cash in the retirement accounts, just to try to lengthen everyone's patience, which is kind of a way of basically turning money away for a while. I mean, it's not complete. It hasn't left the account yet, but it's left the revenue source for us. So,
do you have why has value had such a rough time? Do you think?
I think it's a confluence of factors. I don't know, honestly. Like if I had to assign like how much do I understand or not understand, like I may be in like 50% understanding. I think a big part of it has been the indexation and a just absolute orphaning of some stocks that just get no one is paying attention to them now, and they've just been completely sold off in crazy ways. Like for instance, one company that we own, it was clear as day that they were going to do a dual class structure. And it had been telegraphed for months on end. It was like no surprise when the vote happened and they voted for a dual class structure and went to that. And the next day, all the indexes just sold it off because they had some mandate, like we're not going to hold dual class structure in this index product. And the thing's down, 50% overnight, even though absolutely nothing has changed about the intrinsic value of the company, and the ability of the company to make money. I mean, there was already a controlling shareholder at that point. So it wasn't like this dual class structure changed anything, even corporate governance wise, hardly. Silly things like that, I think, are happening. And I think there's a bifurcation in the market right now where the indexes are buying at any price. When I say index, I should say basically
the cap weighted indexes or the ETF.
Yeah, whatever it is, whether it's a mutual fund or an ETF, is buying whatever price it is and buying more of the biggest and most expensive, and creating its own momentum. I don't know how long that goes on. The other thing too, I think that's really has been the I think that a lot of the cheap, the really, really cheap stuff has, like, let's say the cheapest 10% of the market is not gotten that cheap. Even with this bifurcation, it still has only fallen to like kind of a little bit cheap on any historical basis. One thing we've talked about before, I know, is this idea of dispersion. You have the average of how expensive the market is, and then you have sort of this bell curve around it of, most expensive and cheapest, and how wide is the bell curve when we're looking at it. So let's say that the average stock or median, whichever one you kind of want to use, is at, I don't know, today maybe, 25, let's say, times earnings. But that cheapest 10% out on the tail is down at, I don't know, maybe like 12 or so. Whereas in 1999, 2000, 2001, you had a very, very expensive average at, like, say 35 times earnings, but the cheapest part was at, I don't know, 7 or 8 times earnings. And you had, because it was this story of brick and mortar versus new economy. And so everyone sold off the brick and mortar stuff, and you could get some great assets, great businesses for super cheap at that time. And you had a very wide dispersion between cheap and average and cheap and expensive. And today, I think everything's kind of been squished together. I don't know exactly why that is. Like, I could put my tinfoil hat on and say that it's because of, the Fed or, liquidity sloshing around or indexation or whatever. I mean, I think it's a confluence of all those factors. But the fact is that the bell curve is not that spread out right now, and it's relatively expensive. And so there's like nowhere to hide, basically. I mean, this is what I think Monnier was talking about when he was talking about financial repression. Like, there's just basically nowhere to hide of anything that looks cheap.
That's James at GMO who wrote that article in 2015.
Yeah, and I don't think it's
persisted well beyond then.
Yeah, no doubt. He was early on that.
Well, he said you've got this very difficult choice, or you sort of have to survey the investment landscape, and you have to make this decision if it's either going to remain this way for 20 or 30 years, in which case you should be fully invested and trying to take advantage of it as much as you possibly can, or there's going to be this sort of calamitous crash halfway through it or at any time, in which case you don't want to be that long. And I don't think he resolved it. I don't think he said. I think GMO has sort of tended towards the crash camp because of the way that they have managed their funds. But I don't think that Monnier resolved it in that piece, because I was looking for the answer and I couldn't find it in there.
Yeah, tell me what to do, James.
It's funny. I mean, he's been a great investment philosopher and a value investment philosopher for a really long period of time now. I followed him when he was at Dresdner Kleinwort, and then he moved on to somewhere else, which escapes me now. And I think, like, a lot of people have read him over that period of time, and he's just it's been a rough run for value investment philosophers too.
Yeah, no, I think nothing has worked really. Whether you were talking about what you should be doing or you were actually doing it, everything looked stupid. But that is a choice that in this type of situation, I think you're going to look stupid. And there's no getting around it. I've heard it called maybe like the bubble ultimatum. You have to decide: do you want to look stupid before the bubble, or do you want to enduring it, or do you want to look stupid after it? But there's no getting around it. Like, you're going to look stupid at some point, so it's your choice. I've chosen to look stupid before.
It's a very long bubble. It's sort of the late 1990s was much deeper but much shorter, and this has sort of been this shallow where you're not quite keeping up, but it goes on and on and on.
Yeah, no, it will test. It's testing the patience. But you know what? I mean, this probably should have been expected if you were a value investor in 2008, potentially, of that. It was going to be hard sledding for a while.
Just because it had been so popular and because it had attracted some assets.
Yeah, and I think there's I think in hindsight now, especially after seeing the amount of intervention that's happened in the marketplace with, all these QEs and all the banks printing, and even, the Bank of Japan owning 75% of their stock market now, Swiss National Bank buying billions of dollars worth of companies out of thin air, those kind of things. One of the things that you need as a value investor is for prices to come to you at some point. And if there's sort of a Fed backstop or a central bank backstop there where the price never drifts down enough to you, then you sort of get crowded out at that point. And like, what are you supposed to do then when everything gets bought before your price level where you start to get interested in it? And I think we've seen that over the last several years, that there's just nothing has, even with crazy things, that seem really bad happening in places. I follow the news mostly to like sort of ambulance chase, looking for investment stuff. And it's like nothing happens when you look at the stock price of something and it's like a real problem has happened, or a natural disaster that you would think someone's going to be selling off for some reason, right? Like, we got to get out of this. It's been very rare that actually the market reflects any of the potential change in psychology that might have happened from some disaster that seemed to happen more often in years past, at least in my observation. I don't know. What do you think about that?
I think it's very hard. It's are the metrics wrong? So that's one question that I'm always asking myself: is the way that you're viewing these things wrong? And there are plenty of people who suggest that that's the case. So one of them, price to book value has been historically kind of the academic gold standard for assessing value.
Fama French.
Right. And it's just had its worst decade ever. I think it's negative now for the decade. And then if you talk to like the O'Shaughnessy guys, have got some great research on negative equity impacting price to book value metrics. And they would say, well, it's because price to book value isn't that useful as a metric anymore. And there's some suggestion that it was never that useful as a metric, but billions and billions of dollars have been invested on that basis. So that's always a concern. I think one of the other ones is that the interest rates, if you're doing a valuation, if you're doing a DCF, you need a discount rate. What's the appropriate discount rate? Do you take the discount rate that the market's offering you, which is close to zero, and assume that that's the case over the 10 or 20 or 30 year investment horizon for your investment? Or do you assume some sort of mean reversion back to the historical mean, which is closer to 6%? If you build that into your model, that mean reversion versus a zero that's there for 20 or 30 years, that's a wildly different valuation.
Yeah.
6% gets you a much lower
especially
valuation.
The terminal value on a lot of this is like, you can make it say whatever you want at that point.
Right. And I think the final thing that always concerns me is that the .com argument was that these .coms were just going to take over the world and nobody was going to be able to compete. The bricks and mortar just couldn't compete. And it's not necessarily called a .com. It's not blamed on the .coms, but it's online. Sort of has got to that point where it does seem to be it doesn't mean revert. It just does seem to be taking over. So Amazon is an example of that. Although I think Buffett would say retail's always been really hard. You know, if you had not supermarket, if you had the department store beat out all of the smaller stores, and then the department store needed to be located at the tram intersection. And so that's always been the case. Bigger and better department stores have beaten out the less efficient and smaller department stores. And now we've got Amazon, which is the biggest department store in the world. Nobody's going to get bigger than Amazon. I'm going to be made to look silly in like 50 years time. Somebody's bigger than Amazon.
That won't age well, but okay.
So maybe it's antitrust hasn't been enforced. I don't know. I've got lots and lots of theories for why I'm underperforming.
Yeah, no, I think that's a really interesting question to answer right now. A couple things happening, like really it comes down to like, will earnings mean revert ever? Right now, like profit margins have been crazy high. Is this a new paradigm where the platform company is now, because it's sort of a winner take all, dynamic, is it wildly profitable? And like you can't catch up and they just make all the money and earnings on tech stay super high. And you were an idiot for not recognizing this like sea change and having to go along with it. I'm a little sanguine about that as a thesis. I'm not so sure that like everyone has thought that about everything. That like this is the new normal, this is the new permanent. Like these companies are always going to make money. Just buy it and hold it and forget about it. I'm not sure about that on any kind of very long-term basis, but I could be wrong for a hell of a long time on that, and it much like to a major detriment. So it's very interesting to see value guys even getting sucked into buying, Amazon or Netflix or anything that you look at it and like, gosh, there's so much of the value is predicated on, first of all, them eventually stopping doing reinvestment and like just printing money at that point, right? I mean, all these companies, like I'm not completely sure that Amazon is not just here to punish producers in favor of consumers permanently. Like Bezos just wants to keep running roughshod over all of these producers and providers for the sake of us, the consumer. And I mean, that's kind of been what every really successful retail has done, has been, whether you were JCPenney with a catalog like that was running roughshod over the five and dime that was there, whether you were Sears with a giant department store that was squeezing manufacturers for better deals, like aggregating the purchasing power of all of these consumers that you have, or your Amazon and you're crushing all the brick and mortar. It's always for the benefit of the consumer. I don't know though that necessarily that means that Amazon's going to make all the money ever. Like are they going to be profitable at some point? And I think that's a big part of the thesis. If you're trying to put a DCF on like what Amazon's worth in 20 years, there has to be this big pile of money at the end of that, and not have it be going into the next whatever thing that they're doing. So I don't know. I think those are really tough questions to answer. And those go into my too hard pile. And so I don't have an investment in any of those kind of things, because I just don't feel like I could wrap my mind around what that looks like even 5 years from now. I mean, it's really tough.
I mean, I agree that I think that has been the hardest question that I've encountered frequently, regularly, over and over again over the last 9 or 10 years, that you look at something that is being beaten by Amazon, and is this sort of a temporary thing, or is Amazon going to kill it? And if that happens enough, then maybe I should be looking at Amazon. So then I look at Amazon and try to value Amazon, and it's extremely difficult to do because they run it purposefully at a subnormal profitability, reinvesting in the business all the time. It's a fantastic business. There's no question it's a very, very good business. I have no idea what it's worth.
Yeah. Yeah, and it may just be a destroyer of worlds, and not necessarily for the benefit of the shareholder, but for the benefit of maybe humanity. I think Bezos would probably make that argument, maybe.
Excuse me. Just to go back to, so you talked about dispersion before, which is something we have discussed in the past, and that's basically the difference between the undervalued cohort and the overvalued cohort, or value and glamour, as the academics like to call them.
Yeah.
So you saw something different in 2000 and 2007. You contrasted those two. Do you want to talk a little bit about that?
Yeah. 2007, kind of similar to today, was expensive by most valuation metrics. Actually, less expensive than today. But the tightness was higher in 2007 than 99, 2000. And I don't know why exactly. Part of it was maybe the thesis just wasn't there of like, why should there be a, call it 10% of the market that's super cheap? Like what would be the narrative that would drive that for have everyone throw those away at any price and have everything else be expensive? So I don't know why exactly it was like that, but the dispersion was much tighter in 2007. And what's been really interesting is to actually look at a lot of the value studies and how they've performed over these sort of different time periods and what I would call like opportunity sets of different sort of eras. So if you look at like, let's just take the magic formula as an example, something that a lot of people are familiar with. Coming out of 99, 2000, absolutely crushed. Like, I mean, just putting up obscene numbers, insanity. You get to 2007, 8, 9, 10, maybe even all the way up to today now. I haven't seen the last like maybe year or so, but it did not crush during that time period. And my hypothesis was that perhaps that was because that cheapest 10%, that rubber band, was not really pulled too far away to really get a super cheap stock opportunity set to be a buyer then. So that, I mean, it's really hard to validate all that, like for sure. As like, so, and the other problem is like, how big do you want to call the universe? Like, maybe if you had been looking more international, it completely changes the equation. But I do think there is something to be said for every opportunity set and just trying to evaluate like, all right, is this cheap on a historical basis? Is it cheap compared to like, value versus glamour? What does this opportunity set look like? And how deep is it? How rich is it? Even sometimes the quality of the business might factor in a little bit in that like cheapness. Like, for instance, that 99, 2000 cohort, you had a lot of very profitable businesses that were being thrown away for cheap. There may come a time where that cohort is not profitable and not economically sound. And maybe this is like the things that you're talking about that are getting crushed by Amazon and really are zeros, right? I mean, on any kind of longer basis, like they could be zeros. And I know that, you found in your studies that kind of doesn't matter, that you still buy the cheapest, and that actually the stuff that's most like as far as sort of money going out the door of the business, it actually performed the best because there's sort of a catalyst, I think, maybe there that like, man, things are really wrong here. Like we either need to sell or fix it or something. Whereas if you're sort of profitable and cheap, you can sort of bounce along and just kind of waste time and see if you can get to the next round. That's what you found, right?
I think there's two parts to it. I think roughly 50% of the cheap stocks are going to go down and they're going to get beaten up, and 50% are going to work out. And I think that's true of most stocks. There's just that it's hard to know which are going to work. Yeah. Because there's so many parts going on. They're competing for business, so it could be a competitor that starts hurting them. They might just be too expensive. Management can do the wrong thing. There's lots and lots of things that can go wrong. So I just think if you're looking at the entire universe of stocks and there's lots of stuff that can go wrong, for the expensive ones as well as the cheap ones, I'd just rather be in the cheap cohort, because when the cheap cohort, when they get it right, and that was genuinely mispriced, you get such a good return out of that's why that undervalued quintile, decile portfolio, whatever, that's why it tends to work a little bit better. But that's just not been the case for a long period of time now.
Yeah. What do you think about there's been a couple of books lately that have talked about the intangibles in the economy, and basically that sort of accounting has not kind of kept up with economic reality with so much, when you capitalize all the software costs of a company, let's say, instead of amortizing them and putting on the balance sheet, you you make the company look less profitable. You make the company have less assets, basically, and they look more expensive potentially because of that. Have you thought about trying to do any adjustments to try to add back some accounting value to a company to maybe still stay quant, but maybe make the adjustment to account for how the world has changed with software eating the world?
Well, I think the O'Shaughnessy guys have done a good job with that stuff. They have made lots and lots of adjustments to the balance sheet, and to but I think some of that stuff is hard to know. Is it the correct thing to capitalize a website or some technology that's going to, or some computer code that is going to be earning you money over an extended period of time? I don't really see why that should be treated any differently to a house that does require regular maintenance, or a building that requires maintenance and needs to be built, needs to be some investment. Capitalization might be the correct treatment. For that.
Yeah. Yeah, but I mean, there's also the argument of, being conservative, and also that if they're spending it every year on it to keep this thing up and running, maybe it is really like maintenance kind of CapEx and should just be run through the income statement instead of put on the balance sheet. But I don't know. It's one of those ones that feels like it might be right, but also like maybe the market already recognizes that. And so, you're almost it's almost the same argument of, oh, well, you shouldn't be buying Russia right now because they have terrible corporate governance, right? Or there's a lot of political uncertainty. Well, yeah, that's how you get to a 5 PE for a basket of assets, right?
That's why it's cheap.
That's why it's cheap, right? So if you could come up with a good reason to throw everything out, and so maybe this same thing applies to, backing back intangibles into your numbers. I don't know.
Well, it's a great question, and I'll have to have you back to ask you sometime in the future, because that's the full hour. Just before we go, the book is called The Rebel Allocator by Jake Taylor. It's available in Amazon.
Print, yeah.
Kindle?
It's Kindle and physical, and I'm working on getting an Audible version as well. And lucky for you, I will not be the one reading it, so you won't have to put up with my voice. You'll get a real talented voice actor to do it, so it'll be a much better product.
And this is the book that Charlie Munger loved so much he wanted to see it made into a movie. So I read it and loved it. And I think it's a great, unusual, surprisingly kind of fresh format for what can be a really dry subject. You and I both love capital allocation, but it can be a dry subject. But I think you did it really well. It's a fantastic book. I recommend anybody go out there and read it.
Yeah, and you read early, crappier versions too, so it's probably even a little bit better than what you read.
Jake Taylor, thanks very much for coming on the show.
Thanks, Toby. My pleasure.